Switch to other news. Some banks in the country have begun suspending loans to new and some existing customers. That's information gathered by Joy Business. This follows the increase in the policy rate, the rate at which commercial banks borrow from the central bank, to 24.5%. Charles Nixon has more.
Joy Business understands that some of the foreign banks operating in the country have sent emails to their relationship managers and officers to put on hold lending to new customers. This is to help reduce their risk exposure in advancing loans to the new customers. Usually in times of rising interest rates, the bank's non-performing loans also shoot up, a reason why some financial intermediaries suspend or slow down lending, particularly to fresh customers. This is to help keep the non-performing loans in check. Therefore, despite the demand for loanable funds going up during times of economic challenges, supply remains low. However, existing and credit-worthy customers will continue to receive loans but at a higher rate. According to the latest banking sector report by the Bank of Ghana, the credit conditions survey conducted in August this year indicated an overall net tightening of credit stance to corporate and households by the commercial banks. This was reflected in the steady increase in average lending rates.
Well, Chief Executive of the Ghana Association of Banks, John Uwa, joins us on Zoom to discuss this report. Good afternoon to you, sir. Thank you for your time. What do you make of this reporting? Are you able to confirm this is a situation that some banks are suspending loans to new customers and some existing ones?
Thank you very much for having me on your program. No, definitely not. There is no industry-wide stance on credit tightening. Of course, you should know that the availability of credit is determined by a lot of factors. We have the macro environmental factors, as your reporter rightly pointed out, where interest rate is hovering now. Of course, banks will be looking at the ability to pay back the loans before making any availability possible. If rates are around upwards of 30%, then as a bank you want to look at environmental factors and customers' ability to make good their debt. But the key factor, perhaps, which may be causing the bit of tightening that we are seeing is, if you recall, in August, the central bank came out with some emergency MPC measures, or monetary policy measures, that called for increase in the cash reserve requirement of banks. We were at 12% in cash reserve requirement, and the central bank increased it to 15%. And it was going to be implemented progressively. And from October, the rate increased from 13% to 14%. So definitely that will have an impact. Liquidity will be tightened, and when liquidity is tightened, giving the choice between giving the money to the next borrower and meeting your compliance requirement, which is a regulatory requirement, banks will prioritize making sure that they remain in business, and therefore will keep the liquidity available in order to meet their regulatory requirements in terms of cash reserve requirement. Of course, that squeezes a lot of liquidity from the banking sector, and that perhaps, much as I cannot confirm your reporter's assertion, perhaps may be the cause of a seeming tightening of credit in the environment. But there is no overall kind of lock on credit availability.
Yeah, because the thinking usually is that when policy rate goes up, interest rate goes up, and then banks are in a fixed sort of, and they are, they tend to make it difficult for you to acquire loans because they want to reduce the risks, exposure to risks. Is that what it is?
In credit analysis, just like as individuals, even when we are in our own personal capacity, we are giving a helping hand to someone who approaches us for financial support of one kind or the other. We look at the person, we look at their ability to pay. And if the conditions of the credit is such that getting the money back will be endangered, of course, a bank will take a stance that protects the bank and the financial system. So I wouldn't say that there is, as I said before, a grand scheme to squeeze credit, but a lot of factors are playing and coming together almost in a perfect stock that all points to credit tightening and a banks taking a position that will rather protect the financial system than to worsen it. First is the liquidity availability, and second, environmental factors, and third, even the demand. I'm not sure your reporter has done an assessment on the demand for credit. If interest rate is at that high, history tells us that demand for credit rather goes down, because then individuals also assess the debt burden on themselves. Individuals, businesses, households also do their own assessment of the debt burden, and that will also play a part in whether they actually make requests for credit or not. As for getting demand, it is how effective is that demand, and from what source are they, for bankable projects or people are just throwing stones? And to the extent that we have the demand that are bankable, I'm sure there are banks we have in Ghana who are ready to take on those challenges.
Well, but the policy rate hikes, I want to ask you about it. I want to find out from you, from the stance of the banking sector, how sustainable these hikes are. Because we know, yes, there have been, the central bank hikes the rates to, guard against issues such as inflation. We see that we are in a very difficult situation when it comes to the economy. The local currency not performing too well. But it makes you wonder, is it sustainable to keep doing this when, on the fiscal side, we are not seeing much?
It's a problem, and that is why we are all hoping for a quick end to the current situation that we have, and that the discussions with IMF will go as smoothly as we expect. And as the finance minister said, if a decision can be reached before the next reading of the budget, that will feed a lot into the sentiments that the market will be planning with. As your first contributor mentioned, a lot of these kind of economic challenges are also fueled negatively by news that hangs around. And if people have good expectations of a recovery, or that the IMF program will yield a certain positive outcome, of course, we are going to have a tapering of the market upheavals that we are recording at the moment.
And since you brought up the subject of the IMF, I want to bring that in because the government is in Washington, D.C. to continue with negotiations. And if you've monitored the news lately, there's been so much talk about debt restructuring and its potential impact on the financial sector. I haven't had the opportunity to ask you, what are your thoughts on this, really? As
has been said, a lot has gone on and a lot has been discussed around the IMF program. We would like to, stay away from making a prediction of what position is going to come to, whether it is going to be on fiscal constraints or it's going to be on further tightening of monetary policy or debt operations. We cannot tell. Just like in the minister's statement they mentioned, it hasn't come to that yet. Let's be a little patient. Let's wait for the outcome of the debt sustainability analysis. We also know that a committee has been set up to deal with the financial services industry in our discussions on this IMF program. Let's give ourselves a few more days. I believe that things will come up in our deliberations with the committee, and at that stage we'll be able to give you something that you can really hold. We don't want to add to the market speculation. It doesn't help when everybody is talking about haircut, head this, head that. It's not as easy as people talk, in the media about. It's a big decision for a government to take a decision on whether to take a haircut or coupon or principal or whichever variation of that discussion will come to. But we are not there yet, so let's not rush ourselves to that destination.
All right, so we'll just keep monitoring. John Ewa, thank you so much for your time this afternoon Chief Executive of the Ghana Association of Banks. I appreciate your time. I want to bring in banking consultant Christian Tetteh. I'm sure you've been monitoring our conversation. Still on the subject of advancing loans to new customers and existing ones, as we have been reporting, some banks appear to have suspended. What's your thinking about all of this?
Yeah, thank you very much. Good afternoon, Daryl, for having me. Like Mr. Ewa rightly said, I don't think there is that grand scheme to actually hold credit. And I also will not say it's a standard practice, but as part of best credit management practices, normally in giving out credit, you have to assess the general economic conditions and outlook. And as it is now in Ghana, it doesn't really look good. Treasury bills are over 30%, inflation is almost 34%. Even the credit papers that are actually backed by sovereign guarantee are not that reliable, because government itself is actually struggling with liquidity to the extent that debt to GDP is about 84.6%. And it's projected that before the close of the year, we should be hitting somewhere around 100%. At the moment, we are doing debt sustainability analysis as a nation. So obviously, it is just prudent that some of these banks will slow down on availing credit just to ensure that they maintain a healthy loan portfolio.
Just help our audience understand what sort of risks banks are exposed to during these times when the interest rates go up as a result of policy rate hikes. I mean, they have to deal with issues such as non-performing loans and all.
Yes, absolutely. Now, I mean, we all have to guard against credit impairment and consequent write-offs, especially in this very difficult or challenging economic conditions and environment that we find ourselves. Nobody wants to actually lose money, and the banks are just, I would say, rational economic agents. So they have to protect their assets.
And I want to ask you same question I asked Mr. Ewa about the policy rate hikes. It seems that is the only solution to our issues to do with inflation right now, but it's putting the banking sector under a lot of stress.
Yeah, we can have another conversation on whether hiking the policy rate is what can really solve the situation of inflation that we have in the country. But with the current announcement of the 24.5%, that is the policy rates, it means that cost of borrowing will obviously be high in the region of somewhere around 35%. And when credit becomes expensive, coupled with the challenging economic conditions like the high inflation, the sharp depreciation in the local currency, there is mostly high default rates and so on. And so, I mean, no bank will want to carry garbage in the loan books, hence such a decision to slow down or halt outrightly if there is anything like that. So like I did indicate earlier, there is no grand scheme to actually halt these things, but just that the economic conditions and the situations that we find ourselves are really not favorable. So we all have to guard against some of these risks.
So for anyone looking to secure loans during these times, what do you advise?
Yeah, obviously, if you are new to bank, it will be difficult. If it's an existing customer, you should expect that you are going to pay a higher amount.
And when you say it's going to be difficult, can you explain? I mean, what is required of them? What should they expect, really?
Yes, you know, with the analysis that are done, when it gets to situations like this, liquidity becomes quite challenging. And so the banks have to actually try as much as possible to remain in business and to ensure that there is business continuity. So looking at the outlook, if it's not looking that good, especially with the situation that we find ourselves, you might not be able to go in chest out to say these are new to bank customers, so I'm just going to give everything to them. Definitely you subject to it to a bit of analysis and appraisal. So if it doesn't really look good, especially looking at the economic conditions, no, you might not want to venture in that region. But your existing customer who you've already been exposed to, always giving facilities to, yes, you might want to review what the conditions are. Definitely rates will be higher than what they used to pay with the existing customers.
It's going to be difficult for new customers, but it is not a grand scheme. That's what I'm gleaning from all of this. Christian Tetteh, banking consultant, thank you so much for your time. this afternoon. So